Good afternoon, YouTube. It's John, the Money and Motorcycles guy, with a quick video because tonight is tax night here in the United States. Our IRS and state income taxes, if you owe them, or if you pay them, in states with an income tax, are due tonight. Yes, you can put in an extension. Those of us inside the Southern California, even though it's beautiful outside, actually got an extension because of the snowstorms we had, which were historic about a month and a half ago. But tonight I'm going to talk to you about tax buckets and the way to look at taxes in 3 different tax buckets and talk to you about some of your options there. So real quick, the first tax bucket is generally the income bucket. This is your pay, if you're a salaried employee, if you get tips, if you earn interest and dividends, those count in this income bucket. And unfortunately, Uncle Sam and your state are way out ahead of us, right? There's really nothing we can do there. Our employers have to report that pay, and we end up paying tax on that. Yes, there's some deductions, but this is pretty much your full tax bucket, and it's the worst bucket. So we want to move away from that one if we can. Also, if you get rent, if you own, say, investment property or land that's rented out to farmers or has rights on it, but yes, there's some deductions there as well that you could shorten that, lessen that amount. The next bucket is the tax-deferred bucket. And we also like to call this the alphabet soup bucket because this bucket is your IRAs, your 401ks, your 403b if you work for a nonprofit or a state, for those in the government, federal government service or the military, TSP, these go on and on. 529 sometimes is in this bucket. There's all kinds of those. That's why we call it the alphabet soup bucket. What happens in these cases is your money goes in pre-tax. So you don't pay tax on it. It comes out of this bucket and it grows and it grows and it grows tax deferred. So you don't pay taxes on it as it grows, which is a great option. We have an easy illustration for that. I'll make a video about that in a week or so. But in that bucket, what ends up happening is when you take your money out, you pay tax on it like it's income. So it goes right back into this bucket. I want to tell you a quick story to illustrate this. Say we're farmers and we both farm a soybean, but we want to try corn this year. We're not ready to give up soybean yet, so we both go down to the co-op, well, that's the seed store, and we both buy just 1 bucket of corn. We've got our soybean seed, but we buy 1 bucket of corn each. You buy yours, head back out to your truck, I'm buying mine, and right when I pay, the salesman goes, oh, you know, I made a mistake. I just got this letter from the state that says, John, you don't have to pay sales tax today. And I'm like, man, that's great. You know, some places sales tax can be 7, 8, 9%, and I don't pay sales tax. So I grab my bucket of seeds, and the salesman says, hey, you know, just keep me from getting in hot water. Don't tell your buddy about that deal you got. And I'm like, hey, no problem, man. But I get close to the door, and he goes, oh, wait, I did. Man, I'm really forgetful today. I forgot something else. I said, hey, my buddy's waiting in the truck. What else did you forget? And he says, you know, I forgot. Since you didn't pay sales tax today, you've got to pay sales tax on every truck of corn that comes off your farm next fall. I think about that for a second. And I'm holding 1 bucket of seed that I could pay tax on instead of paying tax on huge harvests down the road. You know, bushels of corn, maybe truckloads of corn. That's what's happening in this bucket. We think that's a great deal because our money's growing tax deferred and we maybe saved a little bit on taxes this year, but now Uncle Sam is a partner in our retirement and he could get 30, maybe even 40, sometimes even 50% of that money when we retire. So the tax deferred bucket used to be a good option, but there's a better option. And that's the tax once bucket and never again. Or we can call that the tax-free bucket. But yes, we do have to pay taxes sometimes, right? So the same situation as the previous bucket, we put money into this account, but in this case, we pay tax on it once, right here. That's why it's taxed once. It grows and it grows and it grows, but then when it comes out tax-free. So you pay the tax on the bushel or the bucket of corn, but you don't pay taxes on the bushels of corn. So you may have heard some places where this works, right? You may have heard of municipal bonds. You probably haven't heard much about them until recently because they were paying such terrible interest rates. They really fell out of favor in the last 10 or 15 years since the 08-09 financial crisis. You may have heard of a 529 plan. That's for your kids' education. You may have heard of a Roth IRA. And it was named for the senator that decided to pass the legislation. His name was Ira. Hey, I tell really bad jokes on Tuesdays. If you're on my Facebook, you get those, my Tuesday troll jokes. No, his name was Senator Roth. And he realized in this case, people were losing a huge amount of their retirement to taxes that they really shouldn't pay. And he put together the Roth IRA that said if you pay taxes on it today, you can put your money in and let it grow and grow and grow and get the money out tax-free. But Senator Roth couldn't get this through. The government, would realize if we don't put any limits on this, most people are going to pour so much money in there and we're never going to get any taxes out of it. So they put some restrictions on it. And even though Senator Roth is long gone, he, left office, he's passed away now. But there are some restrictions on a Roth IRA. The first thing is you can only put $6,500 a year into a Roth IRA if you're younger than 50. Over 50, you can put a little bit more in, but not that much. There's also an income limit. If you and your spouse or partner are filing jointly and you make over $218,000 between the two of you in income, you start losing that benefit. And by the time you make $228,000, only $10,000 more a year, which if you're making that kind of money isn't that much of a pay raise or a benefit, you lose the ability to have a Roth IRA at all. So you can't do it. So there's some negatives there. The other thing is you put money in a Roth IRA, there's only 3 or 4 exemptions on how you can get any money out until you're 59 and a half. Now for some of us, that's not that far away. But for a young person just starting out who says, well, I don't want to pay taxes on my bushels of corn, so I want a Roth IRA, but they're in their 20s, they're locking their money up for longer than they maybe have even been alive. So there's another option here that actually the wealthy have been using for a century or more, and it's called the tax-free plan. Or you might hear it called tax-free retirement, because it's really good for retirement, but it has a lot of other benefits. First off, we'll just say tax-free retirement, so we have a simple acronym. Tax-free retirement, you can put in as much as you want. Some people put $1 million in these. Ross Perot put $1 billion in his. He was a billionaire. He had the money to do it. There's no income limit. So there's no limit on how much you make. Say you're going to sell a business and you might make $1 million that year. By selling your business, you can have a tax-free retirement. The other thing is, once the tax-free retirement plan is in place, you can take the money out at any time. It's your money. Those exemptions that the IRS puts on the Roth IRA, if you need money up for those, a down payment on a home, a medical emergency, you can take the money out. A cousin of mine used his to pay for his daughter's weddings. Then he put the money back in there because it's your money. You can put it back in. And if you want to use it as a retirement, at some point you can turn on income for life. that you cannot outlive. Where here in a Roth, you have to decide how to take that money out. You take it out too fast, the market goes down, you may not have any more money. Here, you can turn it on almost like a pension that certain people still get. You know, pensions aren't as big as they used to be. But you can turn on income for life that you won't outlive. And it's 100% tax-free. So those are your tax buckets. I'm John, the Motorcycles and Money guy. Please hit the like button and the subscribe. It helps my channel grow, and the like button helps get this popular where people can learn this great information on the tax buckets. Have a great night. If you're done with your taxes, enjoy Taco Tuesday, and we'll see you in the next video.